Can't buy yourself a Wagyu burger for $100, no. You Gucci, Smoochie, Federucci, Hoochie, who'll give you change you won't. I said my bit to Franklin, 'cause he'll leave me soon, I know. 100 paper Washingtons all lined up in...
Heidi-ho, YouTubers! I recently had a comment from a YouTuber by the name of, well, I call him Omega Alpha. He doesn't spell it that way. We'll just call him Omega for short. You should check out his channel. He's got some great gardening videos. Anyhow, Omega said, quote, "Foreclosuregate is a big overblown sensationalist story about signers blowing through oppressive paperwork imposed by the government that got overwhelming when so many people didn't pay their payments. It's not like people who paid are getting foreclosed on. It's pretty simple. Pay, keep house. Don't pay for 12 to 18 months, which is insanely lenient historically, lose your house. Since when is foreclosing on collateral for a secured loan for non-payment a radical concept?" Rewind and listen to that again with your eyes closed if you need to, because I think an awful lot of people believe that this whole Foreclosuregate mess is about deadbeats not paying their loans and a few clerical errors. I'm pretty sure the big banks would like to have everybody believe that, but the truth is the whole situation is a lot bigger than just a few deadbeats and some clerical errors. I'm going to try to explain the whole situation, at least as well as I understand it. In order to get the whole picture, we're going to have to rewind the clock a bit, back before the economic crisis started. You see, this whole thing started back when everything was peachy, when the banks had plenty of time to make sure the paperwork was right. So how did all these deadbeats get mortgage loans in the first place? I'm going to post a link below for an article from the New York Times for you. In this article, it talks a bit about Countrywide Financial. Bank of America bought them out in 2008, making Bank of America a huge loan servicer. Countrywide at one point was the largest loan originator and servicer in the country. During the subprime bubble, it had debased itself to maintain that #1 position. Mortgage Guarantee Insurance Corporation did some investigating and tracked down some of the people that Countrywide had written loans to. What they discovered was startling. Here's a quote. A loan for $360,000 went to a Chicago woman who supposedly earned $6,833 a month at an auto body shop. In truth, she was a part-time housekeeper who was posing as the buyer to help her sister. The Countrywide loan officer not only knew these facts, she came up with the idea of having the borrower pretend to work at the auto body shop. The lawsuit uncovered a raft of similar examples. Case after case where the loan officers not only knew that fraud was being committed, but were actively engaged in committing it. So you have a situation where millions of people so badly wanted to live the American dream that they collectively and firmly planted their heads, well, we'll just say that they allowed the mortgage salesman to sell them a bill of goods like a used car salesman. Nobody's saying that all these people should get something for nothing, especially a home. But the story gets deeper, and it's a real doozy. We'll jump forward a little bit and get into that. Once people were sold down the river with these bogus loans, the mortgage salesman turned around and immediately sold the loans to other banks. There they went from bank to bank to bank until they finally wound up in the credit derivatives market. Why did the mortgages change hands so often? Because every time somebody sold one, they got a commission, a bonus. There was lots of money to be made. But there was lots of paperwork to be shuffled in the process. This caused a problem for the banks. Lots of people had to be hired to shuffle all that paperwork. You see, the mortgages got sliced and diced and put into things called mortgage-backed securities, which then got sold on the stock market. The banks got all their money back and then got to make commissions for running the mortgage-backed securities. It was a win-win situation, except for that darn paperwork. So in order to make things more efficient, they talked Fannie and Freddie into creating what was called the MERS, or Mortgage Electronic Registration System. The mortgages got stored electronically in this MERS, and the paperwork problem went away, and the bank CEOs got to buy that new vacation home on the Caribbean. Everything was great, except for one thing: the law. You see, when you take out a mortgage, there are two very important pieces of paper: the mortgage itself and the note. The note is the actual IOU that says you owe the money. And the law in all 50 states says that every time the mortgage changes hands, somebody has to sign the note over. And it has to be notarized by an upstanding citizen of the community. Now, all of these signatures are supposed to be right on the note, written in what's called real wet signatures. But because the bankers were transferring the mortgages around electronically, they just ignored this. What the heck? They're the too big to fails, right? The problem is, if this chain of ownership is broken, you can't prove in a court of law who actually owns the mortgage. Banker Fred could come back and say, "Look, I never sold this to anybody. So who does the homeowner pay? Banker Fred or Banker Sam?" Now you get the problem. The law says that in this case, if the homeowner doesn't know who to pay, then he doesn't owe anybody. So along comes the economic downturn, and out of the millions of foreclosures, a few of them are smart enough to hire a lawyer when they go to court, and the judge says to the banks, if you can't even keep the paperwork straight, the one thing you were supposed to do, then the borrower doesn't owe the money. Well, the banks couldn't have that, so they went out and hired some less than scrupulous law firms to make the whole problem go away. Now, these law firms hired folks that had been, Walmart greeters and housewives, and made them temporary workers but officers of the bank, sometimes several banks at once, which is a violation of the antitrust laws. Sat them down at a desk, gave them a giant pile of paperwork, and had them fix the files. These people are those robo-signers you might have heard of. In some cases, they repaired the missing parts of the files, and in some cases, they simply signed an affidavit that says, "Not to worry, Judge. I went through the file and all the paperwork is in order." This would have fixed the whole problem, except that some of these robo-signers got subpoenaed, and when they got on the witness stand, they did something unexpected and unique. They told the truth, testifying in at least one case where he or she had gone through at least 10,000 files a month. Look, folks, I'm no lawyer or judge, but it seems to me that if you sign something under false pretenses, maybe dating it with the wrong date, or present paperwork to a court saying that it's truthful, it's usually considered to be either forgery or fraud, both of which are felonies in most states. And thanks to the war on drugs, if you're convicted of a felony, say in more than 3 foreclosure cases, it usually means something like 20 years to life. The attorney generals in all 50 states are now investigating for criminal charges, And the hedge funds and the pension funds that bought all those mortgage-backed securities are all of a sudden suing the banks to make the banks buy back the crappy loans that the banks sold them. The Ohio Secretary of State, at least in that state, is investigating 8 notary publics that she says notarized something like 14,000 files a month. And the title insurance companies are getting into the act because they've insured the titles on all the foreclosures that have been resold so far. All I know for sure is things are going to get pretty interesting after the election.
It hasn't been done according to the law. Look, the bottom line is the banks hold consumers to the very letter of every contract. For some consumers, if you're a day late on a payment, up goes your interest rate. Or if you're a day late on a payment, they're going to go ahead and foreclose. And why is it that the banks don't have to follow the letter of the law when it comes to taking something so important as someone's home?
That we are faced with a choice here. We can either have a rational resolution to the foreclosure crisis, or we can preserve the capital structure of the banks. We can't do both. What should we do?